So now it's an honor to introduce our next speaker. He is Mr. Anil Rego, CEO of Right Horizons, a true visionary in the world of PMS. Join us as he enlightens us with a presentation on Grow Your AUM PMS. So I welcome sir on the stage to share insights. We've already had a wonderful discussion and a presentation on PMS AIF. Now we are going to hear exclusively about PMS from sir. Welcome Anil sir, and thank you for making to our presentation.
Yeah, thank you. I've been running this theme on, grow your AUM for, especially for distributors, for IFAs and for RIAs, okay, because I think this is probably the most important aspect for all of us as we sort of grow this business. Okay, actually I think Vyas and Mr. Samir gave a good primer for me. I am stepping one step back into just a question of managing your business, right? So the question is, is it easy to manage say 50 clients of 5 crores, right, or 250 clients of 1 crore each? Okay, so if some of us have to scale our business, yes, definitely we need to look at maybe multiple products and stuff, but I think this is an important question that we need to ask ourselves, right? How practical is it? Because in my experience, in fact, that's something that we ourselves did. We chose to focus on larger ticket sizes. We took a few steps. We reduced team sizes. Of course, the compensation didn't change because maybe that one person earlier, 10 persons earlier was equal to 1 person now, right? And the dynamics on cost may not change, but I think it's important for us to look at, what is it that we want to do on our business, right? So that's a big question for yourselves to ask. And this was one of the IFAs came to me at some point of time and said, you know what, Anil, he ran a bit of a retail business. He came back and said, I grow my customers, they come to a certain level, okay, and then they go away, right? So I was, trying to explain to him that yes, so what have you done to take care of your customer at the next level, right? So if I look at how the whole market is, we have retail investors. Okay, maybe they start off with tax saving options, they graduate to mutual funds, slowly, then you have the HNIs. There are various definitions that you can get on HNIs. Some of them say $5 million, etc. of net worth. Okay, and subsequently you will find more complex products come in. The risk appetite sort of goes up. Okay, and they also want something different out there. And then you have sort of the UHNIs, right? So now the risk that you have of not having some of these products in your portfolio is when your customer gets there, okay, somebody else, the bankers and all the private wealth guys and may just come back and take them away, right? So that's a huge risk that you have. So even if you don't sell some of these products to your customers, I think it's good to have it in your basket and also be able to present the options, because some of your customers, maybe they'll stay with mutual funds, that's fine, right? But you don't want to be in a situation that you miss out, on the larger customers and your bigger customers sort of go away because somebody else has spoken to them. We spoke of, I think Samir spoke of, the biryani of, products, right? So, and PMS, and the question is why? Okay, so here I'll go a little deeper on why. In fact, I think the first is transparency, right? If you go back and see on your PMS, you will actually be able to see the breakdown of all your charges. Okay, it's not that you get your NAV after charges, right? So you can see everything, you can see all the details of it, and that is something which makes it sort of very interesting. You can see the underlying stocks, what has happened to them, when it's bought, when it is sold, right? So all of them are there for you. You can actually look at if somebody wants and has interest in going through those transactions, etc. Flexibility is the other one, right? Because the way the regulator has seen it is that mutual funds are meant for more retail investors, so they made them standardized products, right? Here you can have a lot more movement. A large cap can also move a little bit to mid cap if they want, and vice versa, right? So sometimes it may help you deliver a better return, but also more importantly, if I have a mid and small cap fund and I am very uncomfortable with mid and small cap valuations, as a fund manager, actually I can go and go to safety. I can go to large caps. I can go to larger mid caps, right? So those are some of the things that we are not restricted by. So the flexibility is there. It can also be customized, because here it's not a pool vehicle. Actually, it is individual investors hold their individual accounts, okay, and more importantly, okay, you can also have a new set of managers. If you go back and see globally, right, in the private wealth and stuff like that, niche managers have built a very nice space, right, and they provide very interesting products, very much useful for the larger clients. So that is something which is definitely there, and yes, the returns are also there. I think there was some data, there was some debate. I mean, I am a complete data guy. I can go back and give it to you that this is the percentage of funds which have done better than the average return of mutual funds, right? And I have taken 1 year, 3 year, 5 years, all of them, right? So I am not saying that one is better than the other. You will find at some point something is only 30% are outperforming, but on the mutual fund side as well, I don't think 100% of them are outperforming, right? So it's a good returning market, and I think it's something which is complementary. Now coming back to the main point of our discussion, of how is it that we choose the right PMS, because it is very, very important, right? So the data is not as easily available, like I can just go to value research online and I have everything, right? So this is something a little more difficult. So how do you sort of go about it? I think the first thing is you need to decide, okay, what is the category that you want in the asset allocation that you plan for your clients. Ideally, you should have one which says, if I have a high risk client, this is my asset allocation. If I have moderate, if I have a low risk, right? And within that, and that's why I have not put numbers here, okay, within that you can say, okay, which of these are suited for PMS? Okay, do I want to do a mid cap? Do I want to do a multi cap? And is there something beneficial or different that they provide, right? So that's when you sort of do it. I'll come back on 1 or 2 of the other factors as well. This is how we do it. Okay, for example, we also have, on our PMS, we have a mutual fund of funds. Okay, how do we look at allocation? We also have another fund which is a multi-asset type of fund. Okay, 3 risk levels, etc. So what do? We actually look at data, right? So one look at various data points to see what is the right allocation, right? So for sometimes large cap may be at 20%, not always, right? And we believe that's something that needs to be dynamic, and I think data is the best way sort of to look at it. Okay, what does it do? It helps you reduce volatility. It helps you take advantage of some of the upsides, the market cycles, and if you get it right, it will probably do sort of very well for you. But importantly, I think what are some of the places that it is interesting to look at, right? I think the immediate one is today what is very hot, right? The small caps, okay? And you just look at if you have a mutual fund, say, or even a PMS at 5,000 crores, right? A 5% allocation will mean 250 crores. So what size of company can you invest into? So it means that there are a whole lot of companies that you just cannot invest into on the small cap side, right? So the size of the fund is important. So that is something that sometimes you can consider, that where somebody is looking at a small cap fund, what is the size of that fund, right? So sometimes small is beautiful. Then this other part of it, the second step, after deciding, okay, I want to do either mid caps, I want to do small caps, I want to do multi caps, right, is to come back and say, okay, how do I start screening? Okay, normally most of us look at return measures. Okay, I have actually captured the risk measures and the risk adjusted return measures, okay, because that is important, and slightly more so on the PMS side, because you must also keep in mind that because there is more flexibility, managers can also take higher level of risk, okay, and there could be not so consistent returns. You may have at a good time somebody delivers a great return, but when markets fall, we have seen sometimes that the returns are, the falls are very, very large, at times even larger than the index in itself, right. So, it is important to look at sort of risk adjusted return. The next step is, and part of that is also to, we have tried to capture it for mutual funds, because sort of it is easier for you to look at, okay. Some of the measures, I think for many of us who are writing some of these exams, NISM, right. So, you may see some of these ratios, the background to it. I have a slide also if you want to go through what each of those are, okay. But it is important to look at a combination of risk adjusted return and risk measures and returns sort of in the same page. So, I may just look at a fund which say has a 0.2% lower return on a 3-year basis, right, but the risk is much lower, all the green dots, right. So, the green dots are the ones where it makes sense for you to look at. Importantly, like I also mentioned, this is true for both PMS and for mutual funds, but I think most of us are on the mutual fund side, so I am giving mutual fund examples, okay. The fund which are right now 1 to 5, right, and a 3-year rolling return for the last 10 years is what sort of we have looked at there, right. If I sort of go back for 3-year rolling returns as of August 22, you will find that number 1 at some point is number 17. So, number 2 has gone to number 22, right. So, that is something that we sort of keep in mind. It is also a little sharper because we looked at a 3-year rolling return, not just a 1 year, right. So, what am I trying to say? On a 3-year basis, you will find somebody probably rides the cycle, a fund rides the cycle well, and then probably some other fund sort of takes over, right. So, it is important for us to understand that this is something that will be there, and while we look at it, it is important to diversify, right. So, that is why it is so important. If you are just looking at return data, right, you may actually catch the worst performing funds, okay. So, it is important to look at a combination of data if you need to sort of go there. The third step, okay, is actually to do a deeper due diligence, okay, and that is a whole lot of things that you need to go and look at. For example, what is the asset management company that is offering, the PMS company that is, what is the philosophy of it, okay, how do they manage risk, okay, what is the concentration that they take, okay. Sometimes it is good to have funds which take concentration, because they also can deliver a superior return, right. What is the turnover? So, all of these data you can actually dig deeper and get, and you can actually look at the best performing funds in a cycle. If you also are tracking cycles over a period of time, then you keep in mind that, yeah, I know this particular fund does very well when markets move up, okay, this one does poorly when markets fall, right. So, some of those we bring it in mind, and then we see how to calibrate out, okay. And definitely schemes which have come out in bear cycles will always deliver a great return. So, right now of course, a 3-year return for us also is very good, okay. Of course, there is a good alpha versus the benchmark as well, and that is something for you to look at, but definitely when you look at it from periods like this, like somebody said that 3 years versus 5 years, okay, a 5-year period has not been great overall for the market as well, okay. And yes, areas like corporate governance issues, okay, what are the short term performance spikes? Is it just short term? Is it consistent? How is the fund done when markets have fallen? So, all of these I think are important for us to sort of look at. I wanted to keep time for Q&A, so I'll wrap up a little quickly, okay. So, this is about Right Horizons. We today manage over 1,000 crores of assets. We are across actually almost like 8-9 strategies out there, okay. We have a 12-year track record, okay, 5 branches, and performance has also been 5 years is also there. Okay, if somebody wants to look at, okay, you will find that some of them have delivered some very good alpha out there. In fact, just I think in the last couple of days, PMS Bazaar came back and ranked us Super Value as the number one fund, one of the top 10 funds across all categories in India, right. So, in the previous year Super Value was the best performing all India. The previous year we had the small cap which sort of did well. So, we have been consistent in terms of right through. Interestingly, even on the COVID fall, right, flexi cap did very well, because we fell much lower than the index out there, and the reason for it is we ended up taking cash call. We felt that markets were overvalued. We were able to do it. The PMS allowed us to take that flexibility out there. And just to summarize, I think it's important for us to keep PMS as part of our options for our clients, because we have different types of clients, especially as they grow larger. It's sort of important to do so. It's also important to be able to choose the right PMS, because you can have a huge variety of them in different styles, okay, and some of them could take higher level of risk, some of them may be risk managed, etc. As our organization, for example, we always believe in a risk managed and risk adjusted return is where our focus is. Okay, a 3-step process like I outlined to shortlist. One is to decide what is the category that you want to invest into, then look at past risk return parameters out there, and then do a bit of a deeper dive. Okay, thank you. That's all from my side, and I'm open for questions.
Thank you so much, Anil sir. Okay, we have a question, sir. Please give the mic.
Good morning, sir.
Good morning.
So there are two things I want to ask regarding. First of all, what is your criteria of selection of stocks? That is one, because that is something that you rightly said is the past performance doesn't guarantee your future. So if you could just highlight a little bit about that first, and secondly, taking into consideration the complexity of tax, in PMS as compared to what mutual funds are. I'm talking from a customer perspective. How, if a person even if they fall in that category of HNI or ultra HNI, there is a general feedback that we have got that while filing their returns also, return wise, maybe yes, you are comparing the best ones with the returns, but if you generally see the difference would be 3 to 4% ideally. They're saying for generating that kind of return to getting into such a tax complicancy. Well, how are you going to, as an advisor, how are you going to answer those questions? That will be really helpful.
Yeah, the second one is a quicker one, so I'll just say that yes, tax is more complicated. It is at each individual transaction, but yes, you get an audited report. Okay, but I think 3 to 4% additional return is great. Okay, so I think we need to, if it's compounded, it's phenomenal, right? So it's not small enough, and so I think if we are able to, what we do, for example, work with tax auditors better. So if you have somebody who can sort of work with them, give them the capital gains data, all of that, okay, it may be slightly more laborious, but I think it's okay for clients, right? Coming back to process, right, and see, I worked in Wipro before, okay, and for me process is everything, right? So that's how we build Right Horizons, and that's how I believe also we have been consistent in our returns. Okay, our whole investment journey is broken up into 4 stages. Okay, right from screening process. Okay, so we look at the whole universe, come down to 125 stocks, use a particular screen, long-term averages, risk measures, return measures, exclusions based on certain shadow means holding of the promoters, etc. Right. So then we come down into a deeper dive of this 125 stocks. We do a fund ranking of each of those 125 on some 25 parameters, okay, to make it more difficult for us to invest, because our point is we want companies with great quality. right? And then we go deep dive into looking at the strategy, what are, how are they likely to do in the future, are there headwinds, tailwinds, etc. What is their moat, okay, is something we do. We have another process for risk management, okay, and we do two parts to it. One is at a start, before we even invest into a stock, we do what we call as the forensic, and secondly, we also look at each and every, every quarter, every month, the parameters that we sort of track, because they may deteriorate, right? I may invest at the investment time versus later on they may deteriorate. And the last is about what is a good point to buy and sell, right? So each of them is a process for us. In fact, buying and selling, we have been, because we have that process, it's been really great. Okay, we've sold out stocks just because they were sometimes they were 100 plus P. We loved the company, but valuations we felt were already discounted. Okay, so we just left the company because our whole point is we want to deliver risk-adjusted returns, right?
And so, sir, just last question, like, regarding the churning, what was the churning ratio that you had last year, percentage-wise?
What is that?
Overall, the portfolio churning ratio.
Sorry, I didn't get you.
Your churning ratio on the portfolio.
Churning ratio. See, it depends from fund to fund. I have one scheme, one strategy which maybe it will be some 20%. Okay, we just do 1 or 2 stocks movement a year. A flexi cap portfolio will be a little higher because let's say if suddenly we move from large cap to mid cap, there will be that move which is required. Okay, for us we are very we don't churn too high. Okay, but we believe like we do it for the right reasons, and healthy churn is good for the portfolio. Is what we believe.
Sure. Thank you so much, sir. Thank you.
We can give you data, for each of the funds. Yeah.
Thank you so much for the question. Thank you so much, Anil sir, for answering it so patiently. Thank you so much, Anil sir. Thank you so much, all the audience.